Good day and welcome to our second investment review of 2022. If we look back at the first quarter of the year, investment markets were exceptionally volatile as the world grappled with the realization that the inflation pressures of 2021 were a lot more persistent than had previously been expected. This then flowed through into expectations about changes in what monetary policy authorities, particularly the US Federal Reserve, what they would actually do with interest rates. In the first quarter of 2022, asset prices generally came down after the exceptional performance of 2021, where they had benefited from cheap money. In the quarter, global equities were down about 5%, while the tech-heavy NASDAQ in the US was down 9%. In South Africa, equities were up 3% in rand terms and around about 13% in dollar terms. Global property fell 4%, but commodity prices were up, with gold rising 6% and oil around about 38% higher through the quarter. Global bonds had their worst quarter for many years as they fell by around about 6%, with the US 10-year bond starting the quarter at about 1.5% yield and down to around 2.3% at the end of the quarter and 2.8% at the time of this recording. South African bonds were up around about 2% in rand terms, and offshore cash yields remained very low. Through last year and earlier this year, we commented on multiple occasions that global bond yields were simply too low to make sense as investments. So for our clients in balanced or multi-asset solutions, we have been holding a lot less bonds than would normally be the case, and that has managed to insulate them to some extent against the pain in the global bond market. Cash didn't lose any money in the quarter, but it did show its value in a balanced portfolio at a time when most other assets have delivered negative returns. So, overall for the quarter, local equities did best, followed by local bonds, and then cash, while global bonds, global equities, and global property all delivered negative returns. But that's the past. What's I think more interesting is how we look at the future. 2022 again appears likely to be a year dominated by macroeconomic factors. As we noted in our previous video 3 months ago, we believe that the most important variable this year will be how monetary policy, particularly in the USA, plays out. Remember that interest rates are the price of money, and therefore the starting point for all other asset prices. When the price of money is low, as it was last year, it provides a boost for all other asset prices. The corollary of this, of course, is that when interest rates rise, they serve to drag down the prices of all other assets. In simple terms, think about a home loan. When interest rates rise, your repayments increase, and that reduces the number of potential buyers that can afford the house, and therefore dragging the price of the house down. Over December 2021 and the first quarter of 2022, we saw that equity selection can be important, with a significant sector rotation taking place. Tech shares did particularly poorly, down 10% in the quarter, while financials were down only 1%, and materials and energy stocks were up more than 25%. While the debate through 2021 was whether or not inflation would prove sticky, what 2022 has shown us is it's not just sticky but accelerating. Inflation in the United States hit 7% in January and breached 8% in March. The monetary authorities, who had previously been quite relaxed about inflation risks, suddenly realized there was a problem. This forced them firstly to become a lot more hawkish, and they acted by raising interest rates. The markets received something of a surprise from the rapid change in the Fed's tone. And what we saw was market expectations for interest rates, which had been for only about 100 basis points of hikes through 2022 in January, shifted to now looking for around about 250 basis points of hikes through this year. The impact of this was that other assets derated somewhat, in line with our expectations at the beginning of the year. Unfortunately, it seems as though the monetary authorities in both the United States and Europe are behind the curve. They will therefore need to act quickly and raise rates rapidly in order to catch up. The problem here is that we do now run the risk of them raising rates both too fast and too far. What that means is that it has increased the number of potential scenarios for what might happen economically through the year, and that what we do see is higher forecast risk. At the start of 2022, we said that we expect the strong economic momentum from last year to carry through to this year, driving healthy GDP growth. Unfortunately, the events of the first quarter of this year mean that our expectations have come down somewhat. We do still expect positive GDP growth, just not quite to the same extent as we did previously. Higher interest rates have yet to really bite for consumers, but that will get worse through the year as rates rise further. What is of additional concern is that oil prices are now 60% higher than they were a year ago, and wheat prices are up more than 30% so far this year. That cocktail means that the average consumer now has less disposable income to spend on discretionary goods and services, which will probably have something of a sort of relatively negative impact on corporate profits. At the same time, workers around the world are looking for higher wages to counter this increased inflation we're seeing, which is also a little bit negative for corporate earnings. When we look back in history at other periods when interest rate hikes began, what we've typically seen is that for the first 3 months after the first rate hike, markets exhibited a lot of volatility. But then sort of 6 to 12 months after the start of the hiking cycle, markets rebounded quite strongly. While this might play out again, our concern is that in previous periods of normalization post-negative real policy rates, markets were either in line with or substantially below their longer-term trend. While this time around, when the first rate hike was announced, our global markets were about 30% above their long-term trend levels. What this means is that in line with what we have previously suggested, we do expect 2022 to be a low-return year for almost all asset classes. Our dilemma remains the same as it was a few months ago, in that if the outlook for equities, properties, and global bonds is poor, then what does actually look attractive? Cash will at least guarantee one's money, but with high inflation, you will see negative real yields, so your money will decline in real terms. Having said all of that, that's why we've maybe expanded our tool set over the last year to 2 years, and we're now including more alternative options within our balanced portfolios, specifically hedge funds that look to have highly uncorrelated returns in the sort of multi-strategy space. A few words on global equities. With the changes that we've seen in the last few months, the trend that started in the final weeks of 2021 has continued and even been exacerbated. What we saw is that those stocks that had reached excessive valuations towards the end of last year have suffered the most. Companies like PayPal, Zoom, Peloton, that were real pandemic darlings. Those ones, their valuations were just too high, and therefore they've been impacted more than the rest of the markets. By contrast, a lot of the more boring businesses benefited from this rotation within the market, where we saw the market shift towards favoring what we term low duration stocks, where a greater percentage of the company's valuation sits in the near-term earnings and is therefore less sensitive to changes in interest rates. Our global portfolios, which have more of a quality bias relative to the rest of the market and which have a very strong valuation discipline, should probably benefit relative to their peers in the current environment. But what we do find is that we think overall global equity markets are finely balanced, and therefore we have recently taken a little bit of equity risk off the table in our multi-asset portfolios. In late February, the war in Ukraine caused a supply shock for various global commodities, which of course then lifted the prices and had a positive impact on both mining and energy companies. The South African equity market is a little bit different from its global peers in two respects. Firstly, our market is a lot more resource dependent, So the higher resource prices have generally been positive for our market. And secondly, valuation within the South African market is far less stretched than it is globally. And actually, we see our own market as being priced a little bit on the cheap side of its historical average. So we have a couple of encouraging tailwinds for the South African economy, both the high commodity prices, and we had very good rains throughout the South African summer, which is good for the agricultural sector, which of course is a large employer. That should in general be positive for the rand. The strong recovery in company earnings in 2021 means that company balance sheets are healthy. At the same time, we have quite reasonable expectations from the market for company earnings, and valuations don't appear too demanding. So with all of that together, we think that the South African equity market looks quite a bit more attractive than global equities at this point in time. So all in all, given the change in the global situation, coupled with the fact that our asset allocation calls worked out quite nicely in 2021 when we were underweight global bonds and overweight equities, we think now is a good time for us to take a little bit of risk off the table by reducing our exposure to global equities. In summary, uncertainty is always part of the investment landscape. The current situation, where we have high inflation, rising interest rates, the war in Ukraine, as well as increasing lockdowns in China, means that the volatility in markets will likely continue. Overall, we expect muted returns from almost all asset classes through the rest of the year, and in all likelihood, the volatility may at some point even test our resilience. Ultimately, though, that may provide us the opportunities for the next investment cycle.